this could signal or catalyze like a change in adoption and growth in tech platform?
Sure. The tech platform business is definitely benefiting from, let me say, it could benefit from the areas that you just mentioned. So, a year ago, the amount of demand or interest that we had in blockchain and stable coins and wallets, et cetera, for tech platform partners was really non-existent. But since the administration changed and the OCC came out with the permissibility of crypto and blockchain among banks, the amount of interest in leveraging the tech platform services has really increased quite meaningfully. We don't have anything to announce yet. We're in tons of dialogues with different types of companies. There are companies that are launching a debit card type of product in LATAM countries that's backed 100% by stablecoins. It's not backed by fiat dollars at all, and so there's a fair amount of that. There's also a fair amount of program managers for that type of product. And then, in the U.S., I think there's less activity from financial institutions for those services. It's more in the LATAM countries, but we do anticipate it'll spill over to the U.S. and some of the international companies will look to the U.S. because of it's a more inviting environment from an administrative standpoint. I think the Clarity Act is very important because it will establish into law the permissibility of crypto and blockchain by banks. Right now, we're all relying on the OCC's interpretive letters, and it'd be much better if it was locked into law, especially if the administration changes in a couple years. But I'd say the outlook and opportunities that crypto provide for the tech platform, as well as our own business, are pretty enormous, and I couldn't be more excited about it. It adds a whole nother dimension of growth for us, but it also drives a whole nother sort of lens of innovation across all of our products. And when you have as many products that we have, and you have an entirely new technology platform at a lower cost, at faster speed, and it's safer, it could fundamentally change everything that we do.
The next question comes from Kyle Joseph from Stephens. Kyle, please go ahead. Your line is open.
Hey, good morning, guys. Thanks for taking my questions. On the third quarter call, we talked a lot about capital markets, and I think you guys referenced a flight to quality from investors. Just kind of looking to get an update there. Obviously sentiments change, but yeah, a little bit of a capital markets update and any implications on the competitive front on the personal loan side of things. Thanks.
Yep. Sure. Thanks, Pat. So overall capital markets activity and demand remains extremely robust. We continue to see that flight to quality that we mentioned during the Q3 call. We just had a phenomenal quarter in our loan platform business, transferring $3.7 billion of loans on behalf of others. We just signed a new partner this week for 2026. LPB, and we have several other partners who are in final term sheet stages. So overall demand couldn't be better from an investor perspective. As it relates to personal loan competition, we just had record originations of $7.5 billion in the quarter. We're seeing that trend persist into 2026. So all else equal, we feel great both from a capital markets perspective as well as a borrower demand perspective. In terms of how we're thinking about just as it relates to personal loans and growth in the balance sheet, we are expecting to grow the balance sheet in the double-digit billions, which is in line with what we did in 2025. We're seeing great momentum so far here in early 2026. And we expect that to persist throughout the year.
The next question comes from Peter Christensen from Citigroup. Peter, please go ahead.
Thank you. Good morning. Congrats on the great momentum here. Anthony, I'm curious your perspective. There's been some areas within private credit which have seen some sentiment change more recently. Doesn't seem like it's too much in the direct consumer lending portion of that area. I'm just curious from your perspective, what you're seeing from some of your private credit partners and demand flows there. Thank you.
Yeah, what I'd say is the attractiveness of our assets and our loans is tied to the returns that they have, and we obviously are focused on a prime customer in the business that we're putting on our balance sheet, and mostly what we're doing with partners. And the key is to make sure we're delivering our target return against that. We've been able to manage the performance of prepayments, the performance of defaults, and the performance of interest rates and our cost of funding to deliver great value for our partners. And as long as we keep doing that, they'll continue to be in more demand than supply. With the amount of capital we have on our balance sheet now, I think you could see our growth in originations and revenue and lending start to close a little bit. In the fourth quarter, our originations were up 40% year over year, but our lending revenue was up 15%. And so we're really servicing our partners in a great way, but we could keep more of that production if we so chose, especially given our confidence in our returns.
The next question comes from Moshe Orenbuch from TD Securities. Your line is now open. Please go ahead.
Great, thanks. Chris, you talked a little bit about the allocation between the loan platform business and the core and the balance sheet for your lending segment. Could you just kind of tell us what the contribution from the loan platform business you're expecting in the 26 guide?
Sure. We aren't guiding specifically to origination volumes or LPV volumes for 2026, but what I would say is, we just exited 2025 at a $3.65 billion quarter, annualizes to about $14.5 billion of originations. We feel good about that level heading into 2026. We have sufficient demand from borrowers. Like I said, the new one we just signed up. We have all of our existing partners as well have extended their contracts and often upsized their commitments in periods. So there's sufficient demand from capital markets participants in our LTV program. But like we said, we have a very robust balance sheet, high capital ratios, and we're going to balance the allocation between the two to maximize shareholder value.
The next question comes from William Nance at Goldman Sachs. William, please go ahead. Your line is open.
Hey, thank you for taking the question. Just a lot of good questions already on the call. I just wanted to clarify the comment on the expectation for segment growth rate on the tech platform business. I think you mentioned it was pro forma for the large customer migration. Is there any way you could give us a baseline or just a jumping off point there as we think about rolling forward the next quarter? And then I think separately, I think that customer had spoken about like a fairly large termination fee that they would have to recognize. Could you just confirm if that was in this quarter, or if you've already recognized that, or just how that's being treated? Appreciate the detail of the questions here.
Yeah, sure. So as it relates to the outlook that Chris mentioned, he said 20% growth for the tech platform, apples to apples without the large customer in both years. We're not going to give you more granularity than that. Our outlook assumes no revenue in 2026 from that large customer. The deal with that large customer ended. The revenue also ended in Q4, and the revenue in the quarter from that large customer was part of our contract, and it was equal to the average of the revenue in the last 6 quarters. So I think people will characterize that revenue in a lot of different ways, but the simplistic way to look at it is the revenue was tied to the ending of the contract, or revenue came in at a level that was equal to the average of the last 6 quarters. Chris, I don't know if you'd add anything to that.
No, that's spot on.
The next question comes from Jill Shea from UBS. Jill, please go ahead.
Good morning. Thanks so much for taking the question. I just wanted to touch on profitability. You've posted some really nice progress on ROTCE. I think you posted 9% in the fourth quarter. And clearly there's a lot of momentum in the business, and you've been leaning into capital-light businesses and growing the fee income mix. I'm just wondering if you could touch on the ROE of the business over a longer term horizon. I think you've mentioned 20 to 30% in the past. Has that changed at all? Is the timing of the past changed at all? Perhaps you can just touch on the overall profitability of the business that you're building.
So I would say this. We believe we're building a business that will have superior return on equity and return on tangible equity. We still believe it's in the 20 to 30% range. We are not going to underinvest in the business to get to that number while we're growing at the rate that we're growing. You should expect that we're going to continue to manage the business to a 30% incremental EBITDA margin, and as opposed to trying to drive it higher to maximize ROE in the near term. Ultimately, if you see us growing less than 15% in revenue, you're going to see meaningful margin expansion and us driving to our long-term ROE. Between there and here, which hopefully I'm long gone by the time we get down to 15% from not on the earth any longer, because I expect to be here for the rest of time unless for some reason someone asks me to leave. I hope we never see 15%. But we would be under-delivering on the opportunity in front of us if we didn't keep investing. So we're not just dropping it, all into investment. We're dropping some to the bottom line, at least 30 cents of every incremental dollar in an annual period. And that will give you a good indication of how we can drive returns over the long term. But the growth rates of over 30% that are in front of us this year at the scale that we're at just says we're just getting started. So we don't want to underinvest in that. Chris, you got anything else?
The final question we have time for today comes from Devin Ryan at Citizens Financial Group. Devin, please go ahead.
Hey, this is Noah Katz on for Devin. Thank you for the question. With over $3 billion raised in the back half of the year, you're entering 2026 with a substantially stronger capital position. How should we think about capital allocation towards balance sheet growth versus other strategic opportunities? And can you speak on your appetite for M&A? And also on M&A, please remind us of the hurdles and considerations there. Thank you.
Yeah, so in terms of how we're thinking about capital allocation, like you said, we have 23% capital ratios today. It's over 1,000 basis points higher than our regulatory minimum and meaningfully higher than the regulatory minimum plus our internal stress buffer. So we feel great about the position that we're in. We're in that enviable position where we can grow and put more assets on the balance sheet. These are very good returning assets that we're underwriting today. And we feel good about that, as well as the LPB partnerships, as I've mentioned a few times during this call. I'll let Anthony touch on anything as it relates to M&A.
There's a lot of opportunities out there, I would say more than we've ever seen in our 8 years here. But I'd also say the bar is really high for us. And when I say really high, we've looked at dozens and dozens of things, some of which were for sale, some of which were interesting to us. What we're prioritizing are things that can accelerate our growth versus the time it would take to build it ourselves. So one area we're very interested in is technology platform capabilities. And so wallets as a custody as a service, stablecoin as a service, being able to provide a market exchange for fiat and for different types of stablecoins. Our pay product, SoFi Pay, we launched in September. It is currently using Bitcoin and the Lightning Network to transport fiat dollars from the U.S. to fiat dollars in over 30 countries internationally. And so is there a way for us to accelerate SoFi Pay's international expansion through a technology platform type of acquisition or infrastructure? We're also very interested in international countries and the licenses some small companies could have. In addition to that, in technology platform, we don't have revolving credit card processing and issuing. It's something we can build ourselves, but if there's a technology that's not that expensive and we don't have to pay for a business, we may do that and leverage our technology platform and core plus their processing to enter the revolving credit technology platform services space. There are some horizontal things that we've looked at, but nothing of interest. As you know, we've talked about building big business banking, and we looked at some SMB platforms to see if they would accelerate our opportunity there. The fact of the matter is they don't, and we're likely going to build that ourselves, big business banking, that is, which we have seen really strong positive response from the marketplace as it relates to the need of these services to be a bank that can do both fiat and crypto. So we feel really good about having optionality on our balance sheet. I don't feel good about finding stuff at the price that we want. So far, what I'd say is it's all going to be organic. But if something presents itself in the area that I mentioned at the right price versus doing it internally, we would act on that. But the bar is really high. I know that was our last question, so I just want to wrap the call up. First, thank you all for joining. 2025 was an exceptional year by any measure. the more I went through our results in preparation for earnings day, the more I was able to truly grasp how exceptional the fourth quarter and full year are, looking through any lens, and how far we've come over the last 8 years. I could not be more proud of our team for building a diverse, resilient business that is impacting our members in an unbelievable way, and that positions us to overcome whatever obstacles are thrown our way. All of that said, I think it's an understatement to say that we're just getting started, and I am more excited about what lies ahead than I have ever been at SoFi. You can rest assured that we will move faster than we ever have, we will work smarter than we ever have, and we will be more resilient than we ever have to capture the massive opportunity in front of us. Fresh horses we ride, and look forward to seeing you next quarter.
Goodbye.
This concludes.
Thoughts, everyone? Thank you so much for joining. Good morning. Good morning. We are ready for our Market Open live stream, although that was an abrupt beginning with the SoFi's earnings call. And I want to hear everyone's thoughts. So what do you guys think? It was a blockbuster quarter. I mean, so many records across the board for the company. Record member growth of over 1 million. We got record revenue for the quarter, crossing over $1 billion. That's massive. And then, of course, record originations for lending as well, over 10.5 billion. Although I do not like the fact that most of it, over 70% of it, came from personal loans, which I think SoFi is really kind of moving more towards starting off as a student lending platform. Home loans are up, but personal loan origination is also up. But they are also underwriting very, very well, as their risk models are incredibly powerful. So 37% growth in revenues, over $1 billion. We got adjusted EBITDA up over 60% here, 318 million. We got fee-based revenue also jumping to over $443 million here, up over 53%. And then we're looking at product growth at 37% to a record over 20 million products and about 13.7 million members. That was up 35%. And management also announced some insane guidance for 2026, which we are going to be looking at. Over $825 million of net income is what they're guiding for 2026, which is what we're going to plug into our discounted earnings model to better understand the fair value, the updated fair value. It certainly does not deserve to be a $13 fair value stock anymore. So we're going to update that fair value today, live in front of everyone. We're going to run through some numbers. And then, of course, 1 million new members additions in Q4. And that is up 35%, 1.6 million new products, as I mentioned earlier. And then we got loan originations up over 46% year over year to over 10.5 billion. Personal loans, 7.5. We got student loans, 1.9, and home loans at 1.1 billion. That's up twice as much year over year. Student loans is up 38%, and then personal loans up 43%. So yes, home loans are also moving in the right direction, is exactly what we want to see. In terms of outlook and guidance, so if you scroll down on this presentation, by the way, becoming a one-stop shop for everything, lending, saving, investing, spending, everything's going to be on the SoFi platform as the growth continues to be very, very strong. And then this right here is the guidance for 2026. For the entire year, they're seeing about a $4.6 billion of revenue lift. That's a 30% growth on a year-over-year basis. And net income is going to be a 72% increase from 481 million to over $825 million. So if you look at 2025 EPS of 39 cents, the stock right now is sitting at 25.79. Yes, you can certainly make a case that SoFi at the moment, pre-market, trading at 66 times earnings is a little bit more rich or premium. But if you consider the forward 2026 numbers, we are looking at around 43 times earnings multiple, which for a company that's expected to grow earnings by 54% is not terrible at all. I think it's a very, very reasonable stock, even at these levels. And of course, we learned and listened to the confidence of Anthony Noto in the earnings call as well. He's never been more optimistic about SoFi's future, the resilient capital flows, as well as the balance sheet that they have. They can do a lot of M&A, as we learned towards the end of the call, that it's always going to be strategic and acquisitions of companies that they cannot and do not want to build in-house. So essentially going to be on platform automation, becoming more efficient, reducing cost is all going to be focusing on those aspects of the mergers and acquisitions of the company. So let's look at the potential discounted earnings model for SoFi. So let's run through these numbers together. And so we're going to come over here. We're going to do it for 5 years, okay? So 825 million is what I'm going to plug in for the net income for 2026, okay? And then 5 years on, I'm going to be putting in, let's say, a 25% growth rate. Now, what growth rate do you think is reasonable for SoFi over the long term? Because I think right now analysts are around 25 to 30% growth rate for 5 years out for SoFi in terms of earnings expectations. So if you come over here, earnings are expected to accelerate to almost $1 per share from about 37 cents. So if you do the math here very quickly, we are looking at 37, 1, 2, 3, 4. Yep. So about 25% is what analysts are pricing in for right now. So what is the growth projection for SoFi among our chat? I really want you guys, I really want every one of us to really forecast what the growth is going to look like. And yes, share dilution has been a bit of an issue for SoFi in the past, but it has been a little bit more stable quarter over quarter. As you can see, since first quarter 2024, a billion shares that has gone up to 1.2 billion. But all in all, it has stabilized after 2021. Yes, we have seen a little bit of dilution every single year, but it really was 2020 to 2021. That was the big dilution there. And then of course, since then, it has stabilized a little bit. It is still going up though. So I'm going to be putting in about 5% dilution for SoFi. But I want to hear from everyone. I mean, we've got so many SoFi investors and traders in our community. So we've got so many people watching. We're talking about SoFi. So what is the growth expectations from everyone? I'm going to start calling out people. So I really want to know, what is your expectations for growth in the net income for SoFi over the next 5 years? After 2026, 825 million is what I'm plugging in. So 2026, 825 million. And then beyond that, what is the growth rate that you are expecting from SoFi? So conservative 20% growth projection is what Kev says. So how many people agree with 20%? Going that as the baseline, 20% growth for SoFi. Marcus says 25 to 30% growth in net income. SoFi should be at $40 plus by the end of 2026. We'll get to that. We'll definitely get to that. $150 by the end of 2027. Crazy projections there. But let's just try to underwrite the stock first, right? What is the potential fair value based on the forecasted growth rate for the stock here? So 20%. Okay, so I got a couple 20% now. So let's just go ahead and put in 20%. Okay, forget about the price tag, right? Forget about what SoFi could be in the future, right? It could be to the moon, $1,000, whatever. Well, we're trying to figure out, where is SoFi a very, very good deal for us? Like, where, if we were buying today, what prices do we want to pay so that we're getting great value? Remember, when it comes to investing, we want to pay 50 cents for $1. We always want a good deal. We don't always want to overpay, and we don't want to flex, hey, I'm buying at the highest price. But the biggest flex is that you're paying a very, very good price for great value that you're getting. So in this case, the lowest as possible. If I could pay $1 for every stock out there, I would love to do that, wouldn't I? So our job is to pay as little as possible for as most value as possible. Okay, so 20% is what we're going to use, at least to get started with. Now comes to the PE multiple. Now, what is a price to earnings multiple that you think is fair for SoFi? Granted, it's trading at 66 times earnings in the last 12 months, and it's trading at over 44 times earnings on a forward basis. But I do think that over time, this PE multiple will come down. I think it's going to be closer to 30, because at the end of the day, like, this is not a traditional bank, so it doesn't deserve to be trading at anything under 20. It is, at the end of the day, a fintech company, which has a very big component of technology, which is why the margins are also expected to go up, which, if you come back to the earnings guidance from the business, their margins are expected to accelerate to the upside, right? So we're looking at implied adjusted EBITDA margin from 29 to 34%. And more importantly, the net income margin expansion of 5 percentage points from 13 to 18%. And this could only be the beginning. We could be looking at a company that's generating over 25, 30, 35% margins over the long term. And as a result, that's where I think a lot of that multiple expansion also comes in with that margin expansion. So expected P multiple, I want to see more and more answers. I want to see more people participate for SoFi's analysis that we're doing right now. So they guided for 30% revenue growth. Yes, correct. But 30% is for the next year? As numbers get bigger and bigger, do we expect them to hit 30% every single year? That's the question. Because if you take a look at their actual bottom line earnings, right? So if you come back to net income, they just grew by over 200%. So this number, 481 million, if you come over to their actual income statement, if I can find it somewhere. So net income, let's see, come down here, net income. Let's see, so net income all the way at the bottom. So they were able to grow this by over 100, 200%, but then now they're forecasting for 72%, right, in terms of net income. So those numbers start to come down, right? So as numbers get bigger and bigger, growth rates come down. So that's why it's not just about, we're looking at the next year, we're forecasting for, let's say, the next 5 years, right? Future 5 years of earnings or net income, discounting it back to present value. So 20% growth rate, I want to hear from everyone, what is a fair PE multiple that we can apply for SoFi, right? What is the actual multiple that we can use for SoFi there? So PE multiple, I think it's going to be closer to 30. I think 30 is a fair PE multiple for SoFi. So if we plug that in, and we're looking at a 12% discount rate, 10% margin of safety. Now, share dilution, this is where things get interesting. As I mentioned earlier, since 2021, share dilution has really moderated. And that's what we have to use, because right now it's accounting for the last 5 years, which also includes for 2020 and the big jump that we witnessed. So post 2021, we've seen shares go up by not that much. Of course, not as much as what we witnessed prior to 2021, but they have gone up, somewhere between 4 to 5%. So I think keeping that in mind, I am comfortable with a 5% share dilution, even moving forward over the next 5 years. So if everyone's good with these numbers, we can hit calculate and we can figure out what is going to be the actual fair value based on our collective analysis on SoFi. So $825 million of net income, 5-year time frame, 20% growth rate on that net income. So that simply means that, after 2026, so 5 years from there, we are looking at, for SoFi's net income to be at just over $2 billion. $2 billion, and if we're looking at, let's say, a 20% margin, revenue's at over $10 billion, okay? So revenue is at over $10 billion by 2031. So that is the forecast that we're working with. And you can see 2028, over $6 billion is what analysts are forecasting for, then potentially getting up to $8 billion and then hitting up to over $10 billion by 2030, 2031. So if you hit calculate, we come down to a fair value of $19.55. So a little bit under $20 per share. So it is going to certainly get a big lift from my previous $13 fair value. So we're going to update the shopping list eventually after the earnings season. But from $13, which was the prior fair value, after this entire year is wrapped up and we're looking at a 2026 guidance, the fair value has now indeed jumped to over $19, considering a very conservative growth rate of 20% and a PE multiple of just over 30, which is still lower than where we're trading right now at over 44, which puts the fair value, like I said, at just over $19.55. So that is the potential intrinsic value for SoFi, which $24 is a very strong support. But of course, if you do break down further, next target down to $20 for SoFi, which would also be a fantastic risk reward and a very, very strong dollar cost averaging level right about there for SoFi. So resistance, of course, all the way back up to $30. It's been consolidating sideways in that range for a really long time. So you can see that we've just been consolidating, getting rejected here all the way up to $30 and a very strong support down at $24. Seems to be getting validated here, pushing, of course, after the earnings. But for whatever reason, if in the future we get that breakdown, $20 is going to be that next support, and $19.55 is the new fair value for SoFi. So there you have it. That's the analysis that we did. Of course, we can tweak the analysis with different kind of growth rates. So some people were talking about 35 times earnings multiple with a 25% growth rate. So obviously these numbers are going to go higher. So if you hit calculate now, we're looking at SoFi being undervalued with a fair value of closer to $27, $28. But that's where that margin of safety, that's where your expected analysis, your conviction, and your confidence, all of that comes in. If you believe that SoFi can grow net income by over 25% after 2026, after doubling, almost doubling, and then demand a 35 times PE multiple with 5% share dilution, then yes, at $28, SoFi would be undervalued right now, sitting at just over 26. But if you want to be a bit more conservative like me, and of course build that margin of safety, then we're looking at just under $20 as the potential fair value for SoFi. So yes, S&P 500 inclusion will be a huge lift as well, for sure. I think that's gonna be a great deal for SoFi, very similar to what we witnessed for Tesla and a few other companies that have eventually been added to the S&P 500. As the fund rebalances happen, as institutional funds, hedge funds continue to rebalance their portfolios and have to include for SoFi, that creates a lot of momentum for the company. Now, looking at the big sell-off, silver losing a ton of market cap in one single day, trading now under $100 per ounce, getting up from 121 down to under $100 per ounce here, trading just over 98 bucks, down almost 20%. 20% is a pretty big deal. It's $800 billion worth of outflows from the silver market. And gold prices also tumbling, absolutely taking it in the teeth here, down over 6%, trading just a little bit over $5,000 per ounce, down almost 10% for gold. Insane. That's a $300 billion pullback. So all stocks are forward valued, which means overvalued these days. Well, that's how the market is. Like, we are looking at the forward future earnings and revenues for the company. And it all comes down to whether the future that we're forecasting for is the reality, or is it an overestimation or an underestimation of what the reality will be. So that's why our job as investors is to always make sure that whatever we do forecast for whatever company we're analyzing, we're going in with a little bit of a realistic, objective, and better yet, an underestimation of what the future might look like. So always, plan and analyze for the worst. And if the best case scenario happens, that's the cherry on top, right? That's something that we didn't necessarily put into our models, but that's a good thing, right? The last thing you want is to paint the perfect scenario, the perfect valuation, the perfect everything, the most optimistic and bullish scenario, and for the realistic situation to be way, way short of those expectations. So as I've said this many times before, I'd much rather be conservative and right than be blank. Let's see who can get this. Let's see who can finish the sentence for me. I'd much rather be conservative and right than be blank. I want to see who's been a true member of the MoneyVest community, who's been listening to our videos and our content for a long time. So what do you think is the then be poor? No, but that's true. But I'd much rather be conservative and right than be. Oh, come on, you guys. Really? I say this all the time. Then be sorry? No, it's two words. It's not just a word. I'd much think about the opposites. Think about the opposites. I'd much rather be conservative and right than be. Haven't had morning coffee yet. Oh my god. Well, the answer is then be aggressive and wrong, right? So the last thing I want is to have an aggressive expectation and then be turned out to be wrong or incorrect, because that would be the worst, right? So as I mentioned before, I'd much rather be conservative and right than be aggressive and wrong. So because aggressive and wrong, when you put that together, that can be a recipe for disaster, right? So we want to avoid that at all cost. Then lose money. Yep, all of those are actually correct. Then be cooked, then lose money, then be sorry, then be risky. All of those are very fitting for sure. They all fit very well. ZSL for Temoff. Let's take a look at how this stock is doing. So ultra short silver. Yes, you are right. Up over 33%, Temoff. That's incredible. Absolutely sniping that trade. We were literally talking about this, I think, a couple days ago. I asked you if you were short silver. You mentioned that you were. Man, perfect timing. Great timing here of shorting silver. Incredible. 33% higher. But again, I would not overstay my welcome, given that it is a very, very volatile, and it is, at the end of the day, like a leverage trade. I would treat it for what it is. Definitely do not get greedy. And take profits if you can. So my ELA teacher would beat me for not at least guessing that. Jeez. No worries, no worries. It's all good. So yeah, crude oil prices getting back up to over $66 a barrel. So we're seeing a lot of momentum coming in on the crude oil side. Crypto continues to struggle. Bitcoin's now down to $83,000. We're going through a pretty substantial, dip in crypto. I posted this meme on our Discord, which I think is one of the funniest memes. I just cracked so much once I saw that. I was like, I had to post it on our Discord. But this right here is what I posted on our Discord. Spent 2025 convincing family that crypto was replacing the old system, and then outperformed by my 92-year-old grandma holding gold and silver. That is so true, because at the end of the day, like, who really outperformed over the last couple of years is people who might never look into investing, like people who've just bought gold and silver, like as a safe haven asset. And of course, India is pretty big on literally buying jewelry of gold and silver, and prices have gone crazy, ridiculous over the last couple of years, more than most of the S&P 500. Huge outperformance that has come in for gold and silver. And crypto, on the other hand, the so-called digital gold continues to struggle, 34% down from all-time highs here. So yeah, already booked my $200 profit from ZSL trade in the days. That's incredible. Do we see more dead cat bounce intraday? I think yesterday we had a lot of buyers stepping in. That was quite the reversal. On the daily chart, you can kind of see how crazy that wick was on the daily chart for the S&P 500. So as soon as we got down to that support at 6880, just under 6900, we had so many buyers stepping in, to push us right back above that 6960 level. And so on the day today, of course, we'll find out if we see very similar momentum. Right now we're slightly down, or if we continue to see this pullback further. So QQQs, once again, selling off further from yesterday's sell-off, down about 60 basis points, and S&P 500 also is showing signs of weakness. I think that's really what it is. We're just seeing some signs of weakness kind of surface back in the market as volatility has also been creeping up. So yesterday we got up to as much as over 19, or not 19, but a little bit higher than that. So 19.5, 19.6, a little bit under 20. And then on the day right now, we're up another 5.7%, back up to over 18 levels for the volatility for VIX. Okay, let's see. Yeah, last we bought gold was around 47,000 in India. It is now more than 3 times. Absolutely insane. Crazy what this market, gold and silver market, is doing right now. The market ends different to what it starts. So a green day today, in my opinion, is what Mark says. Why AMD dying before earnings, down 6%. Yeah, I think we've seen some semiconductors really roll back a little bit. I mean, AMD's got a big resistance up to this 267 level, which is just not able to break out of. And yes, it gears up for its Q4 earnings and expects the fourth quarter 2025 revenues at just under 10 billion, plus minus $300 million. Midpoint the revenue range, this represents a year-over-year growth of 25% and quarter-over-quarter sequential growth of just about 4% for advanced micro devices. So that's where we are, and EPS is pegged at about $1.33 per share. That's going to be a growth of about 22% on a year-over-year basis for advanced micro devices. So a pretty substantial resistance at 266. SMH is also down 1.3%. By the way, so we are seeing some semiconductor stocks pull back. I mean, I'm just like looking at SOXL, and I'm like, obviously we exited out of our trade. I don't even know if anybody's still holding SOXL. Like we were trading this back in April and May. We took a nice trade, but is anyone still holding SOXL to this day? I would applaud you if you're still holding SOXL from that trade, because obviously it's a volatile, trade. It's a 3x leveraged ETF, which is why, me personally, I don't recommend holding it for too long, because these leveraged products are created for trading more than they are for investing. And as a result, of course, we took profit along the way, but I'm really curious if anybody's still holding from back in April, because if you are, man, That's crazy. Like 1,000% gain, almost 1,000%, so over 900%. Going to buy a tiny bit of TQQQ today on the chance of an afternoon agreement to avert a government shutdown. Yeah, so leveraged trades, you know, it really is important to snipe them at the right prices. And, you know, this is really a very, very strong sort of trading products. You're looking at volatility, you're looking at the Money Vest Index, you can tie that into your leveraged ETF trading plan, and you can pick it up for some very good prices. So next time, again, we're going to snipe for SOXL, we're going to snipe for TQQQ, or we're going to run that script again, over again. So that's going to be the plan. What are your thoughts on small caps? IWM recently broke out of a 4-year range. So small caps are, in my opinion, I think long-term, they're still solid. However, in any kind of distress or any kind of crises, they are the first ones to go. So, you know, IWM probably has the most amount of growth potential. I mean, in the last 1 year, it's up 16%, not a lot, but year to date, it's performing better than S&P or NASDAQ, up 6%. But if there is any kind of trouble, and also, you know, when it comes to IWM and small caps, they are more, they're less vulnerable to tariffs. They're less vulnerable to international trade, right? It's really the bigger companies, the large caps, mid caps, that are really vulnerable to tariffs and all these trade wars. Small caps are more domestic companies, you know, focusing on domestic products and services, manufacturing locally, and as a result, they tend to be a little bit less affected by trade. But they are obviously a lot more affected during times of recessions or inflation, you know, or interest rate uncertainty. So that's the trade-off. But they also do offer a lot of upside potential because they have a lot of margin for growth, as opposed to mid-cap or large cap. These are already large companies, and the growth is going to be consistent, but you're not going to get those heavy home runs over shorter time frames, which is where you can find IWM and a lot of small cap companies. So long term, I think it's a good portfolio diversification strategy for IWM as well. But I think it's a lot more important to look at individual stocks that are within the small cap space that can grow into a 5x or a 10x opportunity over time. So, but if you look at IWM overall, yes, it's trading at a near all-time high, but it did trade in a range-bound pattern since 2021. In fact, it was at those levels back in November, same levels from back in 2021. So about 5 years of not doing anything, just going sideways. So, okay, markets are open, everybody. We are open. S&P 500 is slightly down about 20-25 basis points. NASDAQ 100 down about 0.5%. How many people feel SoFi is going to give back on all those gains today? What do you guys think? Is SoFi coming back down, or are we going to see some momentum back to the upside well over $26, $27? Again, fair value updated to just over $19.55, a little bit under $20 for SoFi. So that's where we are. Again, thank you so much for joining, everyone. Really appreciate you all. And again, link's going to be down below if you're interested in joining us. Again, live Monday through Friday at 8:45 a.m. until 9:30. And if you want to catch us on the Discord with that 40% annual discount available for 2 more days, today and tomorrow, link's going to be down below. If any questions, email me at admin@moneyvest.com, and more than happy to help. Have a great weekend. I'll see you all in the next